Hi, I'm Jimmy. In this video, I'm going to walk through how to perform a discounted cash flow analysis on a company. The ultimate goal is to try to determine that company's intrinsic value. This is the first video in our new valuation series. Now, I didn't want to just walk through the formula for a DCF calculation and then let everybody fend for themselves. So I'm going to walk through each step and I'll let you know where you can find all the information that I'm using for whatever company that you're trying to analyze. Now, this is the actual discounted cash flow formula. And as we can see, this formula is supposed to help us calculate the intrinsic value of a stock. Now, when talking about the intrinsic value of a stock, legendary investor Warren Buffett, he said that intrinsic value is an all-important concept that offers the only logical approach to evaluating the relative attractiveness of a stock or of businesses. So this intrinsic value can be defined simply as the value today of all expected free cash flow from the future. So to try to keep this video as simple as possible, I've broken this video into 10 different steps, and I'm going to go into each step trying to explain what it is, where you can find it or how it can be calculated, and some best practices. That being said, if you're very familiar with the topic and you want to skip it, or if you want to go over something again, in the description below, I've added links to the various sections within the video to try to make navigating the video a bit easier for you. Okay, now I'm not sure if this is something for you, but I'm actually in the middle of creating an Excel spreadsheet template to calculate this exact discounted cash flow calculation. So if that's something you're interested in, you can find that over on an investing community website that I'm currently building called investorsgrow.com. There's a link in the description below to that website. All you got to do is put in your email address, and then I'll shoot the spreadsheet over to you as soon as it's done. All I ask in return is that you let me email you when the site goes live and then when we issue new updates and things like that. Okay, good. Now let's get started. So this is what we're after. Our ultimate goal is to try to calculate the intrinsic value of the company, also known as the fair value. But before we even get into that, the first thing we need to do is to be sure that the company we're analyzing is well suited for a discounted cash flow analysis. So we want the company to meet any one of these 4 criteria, and then perhaps they'll be well suited for discounted cash flow analysis. The first one is that the company doesn't pay any dividends. And this is actually tied closely to number 2, and that is that the company does pay a dividend, but that dividend isn't anywhere nearly as large as it could be. A lot of companies fall into that category. Now, another reason that a company would be well suited for a DCF analysis would be that its discounted free cash flow is nicely in line with profitability. And then finally, number 4, if we are taking a control perspective, then using discounted free cash flow would make a lot of sense. Now, don't forget, we need any one of these criteria to be met in order for free cash flow to be a viable candidate from a valuation perspective. Now, another criteria that isn't on this list and perhaps is overly simple, and that is that we want to be sure that the company actually has positive free cash flow. So this would likely eliminate early stage company that have a ton of growth, but perhaps they just don't have the free cash flow at this point. On the flip side, large blue chip, more established companies are likely to be very good candidates for this. Okay, so what I did to get the financial numbers that we need for this analysis is I simply went over to Yahoo Finance and copied and pasted each of the 3 financial statements over into Excel. Now, once I did that, I did add some colors and did whatever I could to try to make the whole thing look a bit better for the video, but all of the data is exactly the way it was in Yahoo Finance. Now, as you can see, a lot of this data is blank in here and a lot of it's unnecessary. So from a video perspective, I'm going to be pulling out certain line items to make them more readable for everybody, but I'll bring it out as we go along. Now, you may notice that I'm using Apple in our example. I figure it makes more sense to use an actual company versus a hypothetical company. Another thing we all need to be careful of is that for some crazy reason, Yahoo does the years for each company in this order. I don't know why they go the other way. They go right to left versus left to right. But we're going to be making projections, so we're going to want the data to go from oldest to newest. That being said, once I copied all this data over from Yahoo onto Excel, I switched around the columns to make sure it's going the proper direction. Okay, now let's start calculating. So the first thing we want to do is calculate historical free cash flow. So there are 2 types of free cash flow calculations. We have free cash flow to the firm and free cash flow to equity. Equity is another word for common stockholders. So free cash flow to the firm is exactly what it sounds like. It is free cash flow that is available to the entire firm, including bond investors, while free cash flow to equity is what's available to stock investors. So as you could guess, the primary difference between the two numbers would be interest payments and taxes. We're going to be using free cash flow to equity. Now, free cash flow to equity is good to use as long as the leverage of the company you're analyzing is fairly stable. And here's why. The first thing we need when analyzing free cash flow is cash flow from operations. Now, for Apple, we can see that it's this $77 billion number right here. Then we subtract capital expenditures. Capital expenditures comes from the second section in the cash flow statement. So when we do the math, we can see that we end up with about $64 billion in free cash flow. Now, technically, this isn't correct. This is an estimate. Technically, we're also supposed to add net borrowings to the whole mix. So a cleaner formula would be to do cash flow from operations minus fixed capital expenditures, also known as CapEx, and then you add net borrowings. Now we can see that when we adjust these numbers to account for net borrowings, in 2018, well, it doesn't affect things all too much. But when we look at previous years, well, we can see that Apple had taken out large amounts of debt in the past few years, and that significantly impacted their free cash flow. It made it look much larger. Now, the reason this formula is more accurate is that technically, let's imagine that a company went out and borrowed a bunch of money. Well, if they wanted to, they could use that borrowed money and they could pay dividends. And since free cash flow to equity is how much cash is available to stockholders, well then, in theory, that borrowed money would be available to the shareholders. It would not be available in free cash flow to the firm, but it would be available in free cash flow to equity. Now, many Wall Street analysts that I know don't do it this way. They do it the simpler way. They simply take cash flow from operations and they subtract capital expenditures. And one of the major reasons why they do that is because when we forecast free cash flow, like we're going to do in a second, well, we'll realize that it's very difficult to predict when a company is going to have net borrowings. Okay, now let's project our free cash flow. Now, once again, there are a few different ways to do projections, but I'm going to stick with a way that is simple and it comes up with a fairly effective result. So you may remember a few minutes ago when we rattled off the 4 different reasons why free cash flow might make sense to use on a company. Well, one of those reasons was that the free cash flow of that company was in line with profitability. So if we look at that for Apple, well, we take our calculation of free cash flow. By the way, we're using the simpler version of the calculation, and then we compare that to net income. So we do free cash flow divided by net income. Here we can see that each of these numbers for the past 4 years are about in line with net income. In 2015, it was 131%. 2016, 117%. And then it was 107 and 108% in each of the next years. Now, ideally, what would have happened is that when we were doing our research, and for whatever company we're analyzing, well, perhaps we would have developed an opinion as to where we believe that business is going. And that would ultimately it would help sway our decision as to whether or not we believe free cash flow will continue to act as it has relative to profits. For Apple, in my case, well, I've done some research on the company, and I have no reason to believe that Apple's free cash flow is going to be terribly different than it has relative to profits than it has in recent years. That being said, I think it makes sense to use the 107% number. That's the lowest number in the past 4 years, so using a lower number would make our estimates a more conservative estimate. Okay, now let's go ahead and try to come up with our projections. So once again, there are a few different ways to get to the numbers that we need. Now, we can either try to project net income and then derive free cash flow off of that, or we can project revenue and that will lead us into net income and then come up with free cash flow. Now, I'm going to use revenue. I'm going to project revenue just to illustrate how it could be done. But if you want to try it for net income, you could do the same thing. Same concept would apply. Now, for a company like Apple that has many analysts covering it, one thing we could do is we can go back over to Yahoo Finance and look at their analyst projections. So we can see that they have revenue for 2019 to be estimated to be about $257 billion. And that comes from 33 analysts. So I like our sample size. Now, in 2020, they have us estimated to be at $269 billion. Okay, simple enough. So let's use those first 2 years in our projections. And then we're going to use another popular method for forecasting. Now, let's imagine that we don't have access to any analyst projections, or we don't know if we can trust the analysts that are doing the projections. Either way, one simple and very logical method of coming up with projections is to simply identify a reasonable growth rate. So in this case, we want to project revenue. Now, this would work for either revenue or net income. You could apply the same method to both. So what should our growth rate be for revenue for the 2 additional years that we're going to come up with? Well, we could take the average of what analysts expect to happen in the next 2 years. And if we look at theirs, there's a negative 3% growth rate in 2019 and a positive 5% growth rate in 2020. Average those out, we end up with a positive 1% growth rate. Now, that could work, but if we want, we can take an average of all 5 years. And if we do that, we end up with a 3% average. To me, 3% seems reasonable. Apple is a huge company. It's going to be tough to grow at a big rate for any long period of time. Now, I could probably make the case that 3% is a bit on the low end, but I like being conservative. Okay, so if we apply a 3% growth rate to our final 2 years, well, we take the $269 billion from 2020, multiply that by 1.03, and we get $277 billion. Then we take that number in 2021, multiply that by 1.03, and that grows to $286 billion in 2022. Now, I'm going to stop here as far as projections go, but if we wanted to keep going, perhaps we're analyzing a company that is smaller than Apple, and we think that they have fantastic growth prospects for the next couple of years, then maybe we could extend this beyond just the next 4 years. We could add multiple growth rates for various time periods based on what we believe would happen. Now, I'd be careful about getting too cute with that type of thing, because the further we go out, the more uncertain our estimates are going to become. Okay, so now we have our revenue estimates, and now we need to convert that into net income estimates. Now, we could do exactly what we did for revenue. Ultimately, we could just go find analyst estimates, extend beyond that, find a growth rate. We would do a combination of the two like we did for revenue. But there's a different way of doing it that I think is more logical once you have revenue estimates. So now we want net income margins. To calculate that, we pull net income off of the income statement and revenue off of the income statement. We divide net income by revenue. And what we end up with is net income margins. Now, this actually turned out really well for Apple because Apple consistently puts up similar net income margins. So if we were to average out these 4 years, well, we get 22% average. Now, for me, I'm a bit more conservative, so I'm actually going to use the 21% number just to be conservative. But if you wanted to use 22%, you could do that as well. So now we take our projected revenue and we multiply it by net income margins. In our case, 21%. And just like that, we come up with projected net income. Then we take our free cash flow rate, which we decided was going to be 107%. We multiply that by net income. And just like that, we have projected free cash flow going out the next 4 years. Okay, moving right along. So now we can enter our free cash flow numbers into our discounted cash flow formula. And that completes step 2. Don't worry, the future steps are actually much faster than the early steps. Once we get to the end, we're going to be flying right along. Okay, so now it's time to come up with our required rate of return. Now, calculating required rate of return is actually interesting. Since we're using free cash flow to equity, we are supposed to be discounting that. Our required rate of return is supposed to be based on our individual perspectives. So it's supposed to be based on our investment goals, our time horizon, our available capital, our risk tolerance, the list for things that can influence that go on and on. So if you happen to know what your required rate of return is, then by all means, that's what you should use. But if you're not sure of what to use as far as your required rate of return goes, well, typically we can determine a sort of general required rate of return, and they do that using something called the weighted average cost of capital. It's sort of a default required rate of return. Now, for somebody like me who makes videos and couldn't possibly come up with a fair required rate of return on an individual basis for different people, well, for me, it makes sense to use the weighted average cost of capital. Now, typically, it would be the company that would use the weighted average cost of capital, and you would apply that to the free cash flow to the firm, not to equity, but it can work this way. Now, I've made short videos on both the weighted average cost of capital and the capital asset pricing model, and those are key concepts to coming up with the required rate of return. So if you're interested in learning more about them, you can find the links in the description below. So this is a formula for the weighted average cost of capital. The W's stand for weights, and the little d and the little e, that represents debt and equity. The first section is debt, the second section is equity. Now, the R is the rate that we're trying to calculate for both debt and equity. Now we're going to run through where we get the information for each of these. So how about we start with the debt? Now, generally, if we're looking for the weighted average cost of debt, we should be able to find that in the company's annual filings. If not, a crude way of computing it would be to take the company's average annual interest expense and compare that to the company's total debt. Now, this only works if the company hasn't issued a ton of debt in this year. But in Apple's case, we saw on their cash flow statement that their net borrowings was fairly low for this year, so this should work just fine. So we take their interest expense line item from the income statement for 2018, and we compare that to their total debt. We get total debt by looking at short-term debt and long-term debt off of the balance sheet. When we calculate that, we end up getting an average rate of about 3.2%. Now, that makes sense. That's a type of rate that Apple would be paying, so we're going to go with that. But we can't just take this amount the way it is. Yes, they paid 3.2% on their debt, but in most countries, interest expense is a tax-deductible item, which means the company will pay less taxes because of that interest payments, which means that 3.2% isn't the true cost of the debt. That's what this 1 minus T represents in our formula. The T stands for taxes. So to calculate the tax rate, we take the income tax expense from the income statement and we divide that by income before tax, also on the income statement. Now, we get a calculated effective tax rate of 18.34%. Now, if we were to compare this to the numbers listed in their 10K, because most companies are going to list their effective tax rate there as well, sure enough, Apple gives us 18.3%. So they just rounded the number differently than we did. So now we take our 3.2% cost of debt and we multiply that by 1 minus T. We get a cost of debt of 2.58%. That's the debt we want to use. That's the tax-adjusted cost of debt. Okay, so now we have the cost of debt. Now we're going to need to calculate the cost of equity. To do that, we're going to use the capital asset pricing model. This is the formula for the capital asset pricing model. The first thing that we're going to need a few different things for this, but the first thing is going to be the risk-free rate. Now, we can get that in a lot of places, and I'm going to try to stay consistent here, so I'm going to go to Yahoo Finance for it. There we can find it under markets, then we go to the US Treasury bond rates, and then once that loads, we can see that we want the 10-year US Treasury rate. Right now, that is at about 2.32%. That's generally accepted as the risk-free rate. So now we plug that into the formula here under both of these sections. Next, we need beta for the stock. In Yahoo Finance, we can find beta on the statistics page for Apple. There, they list beta to be 0.89. Now we can plug that into the formula right here. Now we need the expected return in the market. Now this one's a little bit trickier because there's no real clean place to find that. So what I did is I pulled down the average returns of the S&P 500 going back as long as I could find. So I broke it up by different time periods, and then we can elect to use whichever one we think is most appropriate. So I don't think it would be smart to use the 15%, which represents the past 10 years, because we're more than 10 years away from the Great Recession. So in theory, the past 10 years have been so good because you're coming off the lows after the Great Recession. Now, if we use a 20-year number, well, that 6% number since 1999 is sort of the opposite of that. That was right at the high, right before the tech bubble burst. So in that 20-year number, essentially what we get is we get the crash of the tech bubble, another rally before the Great Recession, and the rally since then. So I'm not sure that's a fair representation either. Now, if we're just eyeballing the rest of these numbers, I personally think it makes sense to use 10%. Now, just so we're on the same page, 10% isn't the expected return this year or the expected return next year. It's the average expected return over a long period of time. So if we have reason to believe that the number will be lower than that or higher than that, by all means, adjust this number accordingly. Okay, so now we have all of our components for the capital asset pricing model. When we plug them all in and we calculate it, we end up with 9.16%. Now we need the weights for both debt and equity. And this is actually quite simple. So we take the market cap, which represents the equity, and then we take the total amount of debt out there, that represents the total debt. Apple has a market cap of about $826 billion, and they have debt of about $112 billion. We add these two up, and we get a total amount of capital in the company of about $939 billion. Now, we simply take the $112 billion, which represents the debt, and we divide that by 939, and we can see that that represents about 12% of the total capital structure. Equity, therefore, is about 88%. So now it's time for some basic math, and we can see that our weighted average cost of capital is 8.4%. So now we're going to plug that number into the required rate of return field on our original DCF calculation. Next up, we need shares outstanding. So if we go over to Yahoo Finance, we can see that they say it's 4.6 billion shares outstanding. And frankly, that's a bit vague. Now, if we go over to the company, any company's most recent annual or quarterly filing, well, in one of the first 2 or 3 pages, we can find all the way at the bottom the exact number of shares outstanding. So I'm simply going to take that, copy and paste it over into our formula. Now, one thing to realize with this is that the financial numbers are in thousands, while this is an exact number. So we got to remember, chop off the last 3 numbers here. So we plug that into the formula, and this brings us to the last point, the key data that we need, and that is our perpetual growth rate. So you might also hear this called the constant growth rate. And basically, the perpetual growth rate is the growth rate that free cash flow is going to grow at forever. Now, my personal favorite free cash flow perpetual growth rate is 2.5%. That's about in line with the expected growth of the US economy, most developed global economies. Either way, I'd say it's a fairly safe number to use. It's probably a bit on the conservative side. Now, the key to this whole thing is to make sure that the number is not too large. Imagine we used 5 or 6%. Let's say we use 6%. So if the global economy is growing at 3% and we use 6%, we're implying that one day this company would be larger than the global economy, and that just seems a little bit crazy. Okay, so now we have all of our key data. Now our goal is to calculate the present value of each of our expected free cash flows. So 2019 is time period 1, 2020 is time period 2, and move right down the line. So now we need to calculate our terminal value. So this is the formula for terminal value calculation. And basically what we do is we take our last time period, in our case it's time period 4, and then we take our final free cash flow and we grow it 1 year by our perpetual growth rate. So at that point, we're going to assume that everything grows at that point from our perpetual growth rate of 2.5%. So 1.025 times our $66 billion in the final year. Now this number is essentially time period 5's free cash flow. So now we take that time period 5's free cash flow and we divide that by our required rate of return, which is 8.4%, minus our perpetual growth rate, which is 2.5%. That total, that's 5.9%. So we divide time period 5's free cash flow by our 5.9%, or 0.059, and we end up with our terminal value of a bit over 1.1 trillion. Now, technically, this 1.1 trillion is the time value at the end of period 4 or the beginning of period 5. That's what that formula did. It moved it to the beginning of the period. Okay, so now we have the free cash flow for each time period. And don't forget, the terminal value and the 64 billion in 2022 are the same time period. We just separated them so we can see it. Now, I believe that the easiest way to calculate this at this point is to come up with a discount factor. Now, the way we can do that is we take the required rate of return. In our example, we're using a weighted average cost of capital of 8.4%, and we add 1 to it. So we get a 1 plus 0.084, and then we raise that to whatever time period we're in. So if it's time period 4, you raise it to the power of 4. So our discount factor in 2019 is 1.084 raised to the power of 1. 2020, which is time period 2, same thing, except this time raised to the power of 2. That gives us 1.175. And then we keep doing this discount factor until we hit our time period 4, which is 1.084 raised to the power of 4, gives us about 1.381. And then we simply take the free cash flow from each time period and divide it by that discount factor. And then we will get the present value as of the start of our calculation. So we perform this calculation on each of our time periods. And don't forget, the terminal value gets discounted by time period 4. And then all we need to do is we need to add up each of these discounted cash flow numbers to give us today's value. We take today's value and we divide that by the number of shares outstanding, and we get the intrinsic value of Apple stock today. Now, this brings me to some holes in the discounted cash flow valuation. Now, the biggest issue with calculating DCF is the amount of assumptions that have to be made to come up with the calculation. Now, personally, as I've said before, this is my favorite calculation to use. But even though there's a ton of assumptions, I think that if we're conservative throughout our whole process, it tends to lead to pretty good results. Now, the whole calculation is very sensitive to the inputs that go into this whole thing, so we need to be very aware of that. So if we were to adjust our perpetual growth rate or our required rate of return, you'll see when you do this type of calculation how much this swings things. That being said, it might make sense to do what they call a scenario analysis or a sensitivity analysis. Sensitivity analysis is basically where you say, okay, based on a 1% move in any direction for the different variables that go into the formula, how would that impact things? I personally like to play with that once I have the Excel sheet all set up. I like to play with it and see how it impacts things and then try to pick the most conservative number. Now, if we pick our conservative numbers and we get a discounted free cash flow number of fair value of the stock or the intrinsic value of the stock that we like, the next step, the final step, would be to place our own personal margin of safety to that number. Now, you could, in theory, apply a margin of safety to the different components, but I don't really like doing it that way. I don't think that makes a lot of sense. I think it makes far more sense to come up with the fairest version of the calculation as you can, and then you add a discount to that final number and say, okay, I want to buy it less than that. Now, the reason any investor, professional investors like Warren Buffett or normal investors like you or I, well, we're going to want to add a margin of safety because we understand that there were certain guesses made in this whole calculation. So we want, the more confident we are or the less confident we are, the bigger the gap. The more confident we are, you can have a smaller gap. Either way, I'd suggest that one thing we want to be careful of is make sure we don't mess with the inputs too much to get the numbers where we want them. Wait for the stock to fall to the price that you really should be buying it at to meet your personal required rate of return. So that wraps it up. I hope you found this interesting. If you haven't done so yet, hit the thumbs up, hit the subscribe button. Thank you for sticking with me all the way to the end of the video. If you're interested in the template for the Excel spreadsheet, come over to Investors Grow, plug in the email. I'll send it to you as soon as I can. Thank you very much. I'll see you in the next video.